Hey, welcome back. This is part two of Know Your Money, Know Yourself. And um, again, I'm excited. I really am. This is great. This is fun. I really want to provide you with value and insight. And if you can learn something from my experience, that's fantastic. If this isn't your cup of tea, then good luck and go find what you connect with. But going back to our first video, I was just talking about who I am as an investor and how I invest. Something else that I want to point out that I learned over time was I don't trade after hours now. Really, very, very rarely, but essentially I don't because what I've learned over time um, is that before the market opens, after the market closes, that those after hours, the volumes just drop off. The volume of how much is being traded becomes so small. And then the bid ask spread, which is the bid that a buyer is offering and the ask that a seller is seeking, that spread between the two becomes so wide and the volumes are so small that you really don't get good, accurate price discovery. So I stay away from the after hours. That's me, something I've learned over time, and I would advise, you know, let's say I'm talking to my niece or my nephew, or my son, I would say the exact same thing. And it reminds me of something that I heard on Wall Street, and that is that investing after hours, that you're either the shark or the food. So that was interesting, and I thought a very vivid way to encapsulate that. So, and then the other thing is that I've I sort of, not sort of, I don't look for an edge. I don't look to, try and time the market. Yeah, I've experimented with really quick micro trading and all sorts of, but I've, for myself, I don't do that anymore. Um, it was great learning experience, but these days you've got algorithmic trading, you've got computers that analyze and execute far faster than any of us can, and so I know that especially now in 2025, we passed the 3-year mark of our bull market. We've been in a bull market since 2022, and we've just gone past 3 years of that. And right now there's always speculation in the market, but there's a lot that's going on in the market that is investing in well, companies that aren't making money yet, that have yet to prove shown that they have yet to show a proof of concept. So in my mind, what I would consider to be more speculative trading. Um, I'm not I'm not that. I don't look for the quick dollar. I don't look for the trading edge. I'm really about taking everything, but at the end of the day, the fundamentals of the company matter so much. I can do all of my homework. And like I said in the first video, with all the analysis that goes into the fundamentals and the balance sheet and the leadership, and come back to my thesis and decide that this is a good time to leg into an investment, and um, but it's not, uh, you know if that trade does not go well, I always ask myself before I ever buy, if nothing works out the way that I had planned and analyzed, is this a stock that I believe in? Is this a company? Is this that I believe in? Do I believe in the leadership and their vision and their unique offering and, again, moat to competition, all of that stuff I think is incredibly important. I love the investors of history to me that can be so simple, like Warren Buffett, um, like Peter Lynch from Fidelity, who ran the Magellan Mutual Fund, the most successful mutual fund of all time. Uh, Over 20 years, he had an annual return rate of 29%, which is crazy and fantastic. I mean, at one point in time, one out of every 100 Americans were invested in were invested in the Fidelity, the Magellan Fund. So, but I love their simplicity, the simplicity that I like to start with, that I like to get complicated and then pull it back to the simple and um, go from there. And so, anyhow, um, the that being said, and again, I'm just sort of jumping around my outline and whatever, going off the script. And that being said, that when you do own a stock, and when you get into a stock after you do all of that research, analysis, everything, and come back and say, okay, coming back to the simple, you know, how do I feel about this? My original thesis, checking back in and saying, is this just generally, is this a good time to buy or sell? Talking about Howard Marks, which I think I mentioned in this video, but maybe the last one, he's with Oak Tree Capital and another incredible value investor. And I remember him saying, there are good stocks and there are good buys. And you want a good stock and you want a good buy, because you can have a good stock, but it might not be a good time to buy it, you know, and vice versa. It could be, not a great stock, but a great time to buy it. And I'm going down here because this is your, bargain price. We're always looking for bargains. And like I tell my wife, who is an incredible shopper, like she never walks into the store and starts looking. Like the first thing is walking to the back of the store and seeing what incredible things are, 50% off, 60% off. Um, and not cheaping out or anything like that. But if you are patient enough, patience in investing, then eventually it will move to the back of the store. So, can you manage your own emotions? I think that's a theme here. And that being said, when it is time to buy, as a general, and we can talk about specific examples, but and other situations, but in general, I will allocate a certain amount to a stock. And let's say I'm buying Microsoft. I allocate this much to it, and then I divide it into fours, 25%. And I will put in one part of that 100%. So 25%, which is called a tranche. I'll put in one tranche, and from there, we'll talk about what you can do, but nothing ever gets invested all at once. Ideally, you put in a single tranche and you have patience and confidence in your analysis. And in however much time, could be a couple of days, could be a couple of weeks, who knows, that the price then rises high enough that you then have a buffer to work with. And that buffer is your margin of safety. And that's when we will talk about again the specifics, but that's when you can start taking the other three parts, investing those, and having a margin of safety, to, as you up your cost basis, you also increase that margin of safety. Um, and it's a very comfortable feeling and a very prudent way to invest. that being said, once I am into a stock, I can't emphasize this enough to check in on it every day, and we'll talk about how to do that. That for me, I use Yahoo Finance, and this is my phone that I'm showing that I use Yahoo Finance, and let's say I buy Microsoft, then I go into Microsoft, I put it into my portfolio on my phone every day. Even if you're working full time, you should, let's say, come home, pull up your portfolio, click on Microsoft, scroll through there's a news feed down below. Just scroll through it and see what happened during the day. It takes a minute, takes 60 seconds. See what's going on, see anything that happened with the stock, with anything having to do with the stock. So that's one. It doesn't take a lot. None of this that I'm going to talk about takes a lot of time. Yes, you can go much deeper, but you don't have to when it comes to the analysis and all that kind of stuff. Yes, you need to do your homework, but anyhow, 1 minute to check in on that. And then also every 3 months there's going to be an earnings call. And um, throughout the year, you've got 4 quarters to the year, 3 months to the quarter. So after every 3 months, the earnings calls begin for all companies that are listed on the stock exchange. And those earning calls happen throughout, for a little over a month. And so listening to the earnings calls of what you own or what you're interested in, I think is super important. And that brings me back to what I was saying about getting to know the management of the companies that you're investing in. Um, it doesn't take a lot of time either. You can come home from work. You don't have to do it live. When they have their earnings call, you can come home, go to their website. All pretty much, I think all websites, company websites you go to, up on top, there'll be a tab that says Investor Relations. You pull down to past events, and then you'll click on the webcast and or earnings call, and you can listen to it from there. Just listen to the first 15 minutes of it. Get a feel for the chief executive officer, the chief financial officer, and how much of communication is nonverbal. I swear, even listening to the earnings calls, you get the idea for how these people are. And um, just for an example, I don't I don't I prefer not to have a CEO is um, who is hold that thought. I'm just checking in on the time. I prefer not to have a CEO who is rah cheerleader. Instead, I prefer someone like Jamie Dimon, who is the CEO um, of the CEO of JP Morgan Chase. And he reports and he always underplays. I always prefer that in a leader, that they underpromise and overdeliver. And I'm going to pick that up on the next video. Again, I'm going to cut this off here, make it kind of a nice, size. And so I'll see you in the next one. Thanks.